it's kind of interesting that the high yield market is probably the highest quality it's ever been, and the investment grade market is the lowest quality it's ever been. Cisco was the Nvidia of its day. It was the ARM supplier. And towards the end of the cycle, they started financing some of their clients to purchase more routers. It's happening with Nvidia already. They're starting to finance via joint ventures so they can afford to purchase more chips. You're going to continue to see most of the defaults are going to be in the private credit area. I don't think it's systemic because every company has a different business model. The Fed's kind of caught in the box, right? So their two mandates are inflation and employment, right? It's supposed to keep them both steady. Unfortunately, they have to favor one or another. They can't do both at the same time.
Hi, Carl. Welcome to Excess Returns.
Thank you for having me.
We're excited to have you on today. You are co-president and co-CIO of Osterweis Capital Management, and you are also the portfolio manager on the firm's Strategic Income Fund, a top-rated fixed income fund with $5.8 billion in assets, and it has a track record pretty impressive going back to 2002. So that's 24 years. I'm doing my math right here.
Almost.
Yeah. Talk about like survivorship in the fund business. One of the things that I pulled from your site is sort of you have these three principles that sort of guide the firm's philosophy. And that is the firm plays both offense and defense on the strategies. You focus on absolute returns. And number three is you always want to be focused on the importance of looking at and evaluating strategies through a full market cycle. And so, today we'll talk about some of those things as we work through your investment process and how you think about sort of the risk and opportunities in the fixed income market today, and sort of how you build portfolios and how you manage your fund. So investors can learn more at osterweis.com. You can just go there. It'll be up on the screen here. All right. So as a starting point, I thought it would be good just to work through, and we don't spend too much time here, but just the various segments in the fixed income investing landscape. And so can you walk us through how you would define investment grade, high yield, leverage loans, private credit, and how you think about each of those segments of the market in terms of like transparency and risk? I know it's a pretty broad question, but I think our audience would benefit from that.
It's an important one because we've seen some big shifts over the last 10 to 20 years. It used to be a fixed income investor would show up in the morning and he'd have a choice. Investment grade, non-investment grade, that was pretty much it. In investment grade land, you have, government securities, agencies, and investment grade corporates. Those are determined by the rating agencies. They have, drawn the line between, the bonds they rate triple B and up as investment grade and double B and below as non-investment grade. But these days, it's gotten more layered than that. There are different flavors that I'm not going to get into to this point in the discussion, but in below investment grade bonds, there are now two new cohorts, and you mentioned them. One is private credit, which is just what the name entails. They're not public. They don't trade. They don't get mark to market for the most part. The investor has to be locked up for a long period of time. And it is, or at least it was, the shiny new toy of fixed income for the last few years. And a lot of money has been raised to, invest or lend to what typically are smaller companies. We think riskier companies that cannot finance in the public markets. And, there are companies that have been doing this for decades, Ares and, Blue Owl, companies like that have large networks to source these borrowers. The newer players that have raised a lot of money have to put that money to work, but they may not have the networks that these guys do to source money. So I tell you, I must get 2 or 3 emails a week. Does Osterweis need money? These are some of these funds that this is how they find borrowers. I can get you approved for, $1 million, $2 million, so they can make a loan. These are typically floating rate bonds. They are loans. They have very few covenants. And, there's so many people looking to lend money that the borrowers actually put them in competition. So the spread in the yield that you are getting early on in this game versus the public markets has shrunk because of the competition to lend. There's also a market called the leveraged loan market. Now, back in the old days, before 2008, most of the borrowing by corporate America was done at the bank level. So banks would lend you money. They would do credit work on you. They would, make sure you're a worthy borrower. And then they got the bright idea, well, it'll probably be easy. I won't have to take as much risk if I, arrange a loan and then sell it off to investors. So they make these loans and they basically sell them off to investors. And the way they do that is they'll take a pile of these loans, put them in a vehicle called a collateralized loan obligation. And then what they'll do is they'll slice and dice. So, the top tier is, they call them tranching. So the AAA tranche may be, 20% of a CLO. And they'll back that with, say, 35% of the loans in the portfolio. So if there are a lot of bankruptcies, you won't get hurt because the losses go to the lower tranches. Now, the equity tranche takes the first losses, the BBB, AAA, take the next losses. So that became a marketing tool. Basically you can lend as much as you want. You throw them in, some good loans, some bad loans. They've come up with rules on how much triple C's you can have in those because that got into trouble in 08, 09. So that's sort of the next level of quality above private credit. Private credit is the lowest quality. And then you have the leveraged loans are the next highest quality. And then above that is the high yield market, which is the non-investment grade. And above that is investment grade. Now, what's happened because of that migration of the lower rated companies to the leveraged loan and private credit markets, the composition of the high yield market now is, I think it's 54% of the high yield market is now double B rated, which is the highest rating. Conversely, the triple C, which is the riskiest part of the market, has been more than halved as a percentage. Used to be about 20%, now it's about 10%. In investment grade land, interestingly enough, the same thing has happened, but in reverse. So there, the triple B market, which is the lowest rated part of the investment grade market, is slightly over 50% of that market. Used to be maybe 30%, 35%. So you've seen this convergence in the sort of the belly of the ratings in double B, triple B. So it's kind of interesting that the high yield market is probably the highest quality it's ever been. And the investment grade market is the lowest quality it's ever been if you weight the different rating tranches.
Well, what's also interesting with this is like out of the financial crisis, we regulated the banks and they tightened their standards but it's almost like as a result of that, the market is now maybe more fragile with, some of these private credit leverage loan type areas, and they become more important in like the lending structure of things. So it's like, it's interesting how it kind of hopefully doesn't backfire, I guess.
Well, it's people will always find a way around,
Yeah.
rules. And that's the problem. Banks, clearly because they typically receive taxpayer bailouts, need to be protected against their worst instincts. So they have gone from being lenders to arrangers. And that's a lower risk business. Now, I will say this, that they are now lending more to institutions, non-deposit making financial institutions that actually make those loans. They actually lend them money to fund them. That percentage of the bank's books to those institutions has more than doubled in the last few years. So they're actually can't really help themselves in terms of lending money to these guys.
Right. Yeah.
It's indirect now, but it's happening. So we tend to avoid any private credit. We tend to avoid leveraged loans. We focus in the high yield bond market investment grade bond market when it makes sense, and the convertible bond market, which is a entirely different kettle of fish.
One of the things that we love here and that is important is like these investment frameworks and sort of methodologies that, firms have and develop. And one of the things that you've talked about is this 2-cycle approach to investing in the bond market, the interest rate and the credit cycle. So can you just sort of walk us through those cycles and how they interact and sort of how they're interacting with each other today?
Today is odd, but I'll get to traditionally how they interact. Typically, what you have in an economic cycle is the economy, it gets stimulus, it heats up, it's going along well. And during that part of the cycle, interest rates are rising because demand for credit is increasing, right? You're doing well. You want to spend more money to grow your business. You borrow some of it. You're public, you might issue some equity. So interest rates rise. Now, they typically would rise to a point where, it gets too expensive and, or the economy starts to weaken so you don't borrow as much and you go into a recession because either, you're getting crowded out by the Feds, government borrowing because they're borrowing as well, or the economic cycle has run its course and then interest rates start declining. So in the period where the economy is growing and interest rates are rising, what you don't want to be invested in is what people traditionally think of as fixed income, which is the investment grade market, which these days they call core plus, whatever you want to call it, because you're not worried about bankruptcy in those bonds. So the only variable that affects the price of those securities is the interest rate. So if the interest rate is moving up, your bond price is moving down and so are your returns. Conversely, when you are going into a recession and interest rates are coming down, that's when you want the safety of investment grade because rates are coming down and bond prices are moving up and so are your returns. So investment grade, as exemplified by treasuries, for example, do very well going into recessions because rates are coming down and prices are going up. It's a 1-to-1 ratio. Now, it tends to be a step-ladder function. So the highest rate AAA bonds will do the best in declining interest rates. The single A's will do second best. The triple B's will do third best, et cetera, all the way down the credit cycle. And typically these episodes are much shorter in duration than the recoveries because you typically have the Fed coming in since '08. They come in with guns blazing, providing tons of liquidity, lowering interest rates. So it tends to be, heals much faster than it would if you didn't have a Fed. Conversely, when things are going well for the economy, they just kind of stand aside and let things happen. And human nature being what it is, everybody likes growth. So those tend to be longer parts of the cycle. So what you find is the time you want to be in investment grade is a shorter period of time than the time you should be in what we call economic beta or high yield, things that benefit from an improving economy. And the reason that sub-investment grade does well in an improving economy is that people feel comfortable with risk. They feel more comfortable. They feel more comfortable about default risk, and they require less of a premium over the risk-free rate, i.e. treasuries, to buy those bonds. So that we call that spread. So your spreads are narrowing, and as your rates are rising, so you don't get that hit that you would on investment grade bonds. That's why high yield has been such a great asset class for so many years. And that's where we tend to focus mostly. Last time we were big in investment grade was when we had the inverted yield curve. We were buying shorter dated bonds at higher yields than longer bonds. That's just common sense.
I was thinking back to your first answer when you were giving that answer, because this idea of you want to be an investment grade around recessions, I'm wondering if that's somewhat minimized by the fact that high yield is better than it used to be and investment grade is worse than it used to be. So maybe there's less case to do that now these days. Is that fair?
I would agree with that assessment. There is less of a case. There's still a case to be made, but it's more of a trade than an investment at this point. You've got to know when to get in and when to get out, whereas high yield, if you buy short dated high yield in some of the higher quality companies, you're going to be just fine. In 2008, we had a barbell of treasuries and very, higher quality, high coupon, short dated high yield. And we had positive returns for the first 3 quarters of 2008 with that barbell. Now, after September of 2008, we decided to, get back into the high yield market because it had gotten pretty beaten up. Rates were at 1.5%. We thought they had done what they needed to do. We were 2 months too early, and we were down 5% in '08 as a result of being 2 months too early. On the big scheme of things, it doesn't really matter because 2009 everything took off, so we were fine. But it just goes to show that you can have positive returns in high yield, even in a recessionary environment, if you buy the right part of the market.
You mentioned the economy and the Fed and interest rates. How much for what you do you have to have an outlook? Like, how much do you have to try to figure out what's happening with all that stuff to do what you do? And how much does it not matter that much to what you're doing?
It's very important to know where you are in a cycle. Now, that doesn't mean you need to know whether you're in the bottom of the third or the top of the fifth inning, but you have to know whether you're in an expansionary part of the cycle or a contracting part of the cycle. That's very important. The good news is it doesn't change but once a cycle or twice a cycle, depending on how you define the cycle. And it's usually pretty obvious where you are. And, when '08 hit, even in '07, you kind of knew that real estate was overvalued, that you were going to have some kind of credit cycle. And it was July of '07 when, our Treasury Secretary were bringing out the big bazooka. When they start talking like that, you kind of know, it's time that's when we started buying treasuries. And it's harder to know exactly when the bottom is going to be, but you can start getting a sense for it by seeing the actions that are taken, the liquidity, and seeing which companies are going to be the survivors. And a lot of it is some of it is just an educated guess. When you are more certain about future returns than near-term returns, you're probably at a turning point. When you are less certain about long-term returns than you are near-term returns, you're probably at a turning point as well.
It's funny. I was thinking of your answer. I was listening to a guy who was a great macro investor, and people were saying, oh, you must be a great forecaster. And what he said is like, I'm not a better forecaster than anybody else. What I'm really good at is figuring out what's happening right now. And it seems like that's the same type of thing you're trying to figure out.
One of our favorite comments here is we don't make bets. So making a bet is, I think interest rates are, where they are today. I think the Fed is going to cut 3 more times, so I'm going to buy some 10-year treasuries. That's a bet. You're right. You could be wrong. The guys who are right are hailed as geniuses for that part of the cycle, and then they generally can't repeat for another 10, 15 years. But be that as it may, if you look today and see, okay, the outlook is sort of okay, the economy's still hanging on. Everybody sort of knows where we are, but everybody's trying to forecast, as you say. That's what economists get paid. They think they have to forecast. I'd rather have an economist just tell me where we are and what to look for, because that's more important.
You've described your approach as buying bonds like a stock picker. Can you explain what you mean by that?
Sure. Most funds when I started this fund, it was started to be the only fixed income investors our wealth management clients would need in their portfolios over many cycles. And so we had a very flexible mandate. And most mutual funds back then did not have, multi-sector funds weren't a thing back. I came up with the theory of, buying high yield at the bottom of cycles, buying, treasuries at the top of cycles, combining them with convertibles here and there. And I said, let me go see if there's some funds that have done this, see how they've done through cycles. I couldn't find one. So most funds are marketed according to style boxes. So Morningstar has done a really great job in convincing people that there are nice, neat boxes that they should invest in. So if you want a high yield allocation, you go buy a high yield manager. His mandate is he has to be in high yield, even when high yield looks horrific. Core has to be an investment grade, even when interest rates are rising. And you saw that the last 5 years, their returns have been, virtually nil. They're just starting to get some returns now because they were there in 22. It's sort of a race. When you start with 0% interest rates and you raise them to 5.5%, guess what? You're going to get hurt. But they can't avoid it because that's their mandate. That's the box they're in. And we don't believe in boxes here. So what we do is, and take that a step further to answer your question, is a corporate bond fund or a high yield fund that is sort of benchmark, driven, typically owns most of the names in the benchmark. He may not own every tranche of every issuer, but he pretty much owns every name. And I would, if I had to guess, probably 10 to 20% of those he really doesn't want to own, but he has to own because they're big issuers. So they may have 300 to 700 positions in their funds. We say, okay, I'm not going to do that. I'm going to find really good companies that we can invest in for the long term. And I'm going to buy what I think is the best value in their bond stack. Typically, they have one or two bonds. We prefer that rather than the big issuers, because in indexing in fixed income, it's different than equities. In equities, it's success-based, right? The best performing companies get the biggest weightings. Well, we have the Mag 7. They've been terrific performers. They have huge market caps. They've been the most successful stocks. That's how they're weighted. In fixed income, it's the other way around. The companies that issue the most debt have the biggest weightings. And the companies that issue the most debt are usually the most levered companies and those that are most likely to get in trouble. But as a benchmark investor, you have to own them. Because if they move up and you don't have them, you're short to the index and people are asking hard questions. So we typically have many fewer positions than a benchmark fund. So we pick and choose, we do research. We have 4 very senior portfolio managers on the team, and we structure ourselves a little differently than most funds. So we all take a look at each name. So we'll all be on with the management, and then we'll reconvene. And what we try to find are companies that are, one, good stewards of capital. And by what? We differ with our equity peers on that, in that we think a good steward of capital is not constantly buying back stock and returning money to shareholders when you have debt. If you're throwing off a lot of excess free cash flow, sure, return some to equity holders, but be careful with your cap stack, because that could come back to bite you. Equity is permanent capital; it has to be repaid. So we look for that. We look for businesses that have a need to be there. One of the questions we ask ourselves: if they went away tomorrow, would anybody notice? A lot of E&P companies went through 2 bankruptcy cycles, and those that disappeared, you couldn't name 5 of them, because they're all the same. They all dig for oil in the ground and they come up with oil. They have times when the price is high, they do great. Price is low, they don't do so great. So we tend to eschew that commodity part of the market. We like companies that are unique, have defensible moats, throw off free cash flow, have reasonable leverage, and run their businesses for growth. We don't want to lend money to a company to pay a dividend to private equity holders. That's not productive use of capital in our view. So we have about 120 portfolio companies versus the 300 to 700 that other funds have our size. And we will take multiple tranches, so we have about 160 positions. And what that does is 2 things. One, you have management access because you're typically the largest or second largest holder of whatever bond issue that you own. So you get management's attention. As I said, we don't make bets. When we buy a bond, if it's at the right price, the right yield, and the right, characteristics that we like, we buy it with the intention of holding it. So our turnover is very low. We've been with some companies now for 17 years. We've been with one company. various issues, of course, could they refinance their bonds? But we get to know the company really, really well. We're on first name basis with many of our company CEOs. And when it comes time to refinance, we fight above our weight, because a lot of times the management will tell the underwriter, give these guys what they want, because they like having us as bondholders. We tend to leave them alone if they're performing. And when they don't performing, they hear from us.
A few follow-ups on that. One is, I think what you said about the bond indexes is really interesting, because I think that's a thing a lot of people who come from my world in the equity side don't understand, which is that, everybody's used to the S&P 500 dominates all active managers. You should never use active managers. And then you go into the bond world and the indexes are constructed in a much less sensible way. So there's much more of a case, I think, to be using something active on the bond side than there is on the equity side.
Well, it's actually constructed the same way. It's those that with the largest caps, largest weightings, are the largest, weightings in the index. And the problem is how you get there is different. In equity, you do it through success. In fixed income, you get through excess borrowing. So, these companies that are, some of them are large companies that have, 30, 40 bond issues, and they're issuing a new bond every couple of months, it seems. Those are the big weightings. You find that, I think 7 out of the top 10 companies in the high yield index are triple C. I haven't looked at it in a while, but they don't tend to be the higher rated companies. They tend to be the lower rated companies that constantly need to borrow money.
And going back to the type of companies you own, it sounds like you would be more inclined to own staple type companies rather than cyclical type companies.
Correct.
Am I thinking about that right?
You're absolutely thinking about that right. Some of them are, look, I'll give you a couple of examples of industries that we really, really like. We like distributors. So food distributors, U.S. Food, Unified, Katie's an organic food distributor, Performance Food Group. We own all 4 of them. We don't have to make a choice. It's a great business. If the economy goes into recession, are you going to stop eating? I don't think so. I don't know about you, but I'm not growing my own food. So I go to the supermarket, and guess who supplies them? Food distributors. You go to a restaurant, who supplies them? Food distributors. No matter where you go, they're supplied by a third party. We love that. Wesco, an electronic equipment distributor. They distribute, for building all the wires and electrical connectors and what have you, conduit, They don't go buy that from separate. They just go to Wesco and just get it all in one package. So distributors are a terrific business. The other one is equipment rental firms. Think of the equipment rental business. When times are great, these guys are growing like a weed, but they do it by spending a lot of money on new equipment, because they need new equipment because their customers are building lots of stuff. When times get bad and everybody, pulls their horns in and don't build as much, these guys shrink their fleets. They sell off their equipment. So what happens is, during the growth period, their revenues and earnings are growing and EBITDA is growing, but their cash flow is not. The cash flow is actually shrinking because they're buying new equipment. Now that's an asset on the balance sheet. When a recession hits, they're selling off equipment. There are companies that have huge operations that do that for them. Their cash flow goes up. So when everybody's in recession, their cash flow is rising, which is very defensive. So if you think about, what type of companies do I want to lend money to? It's those that A, can withstand a recession without going bankrupt, and B, have a constant source of demand and not a lot of competition.
I'm just curious, because in the news, recently with Meta and Oracle, issuing debt to finance these, AI build-outs, and just that whole entire development, you as a fixed income investor, like, what are your thoughts when you see something like that and you've been through these boom and bust cycles? Does that give you any pause, or like, okay, I'm seeing signs of this isn't good? Or how do you sort of think about that? Or have you thought about it?
Gives me the willies. We had a big, long discussion in our internal research meeting with the other teams today, as a matter of fact, about that. And the real, I mean, those of us who have been around long enough saw it in 2000, right? It was the internet build out. Cisco was the Nvidia of its day. It was the ARM supplier. And towards the end of the cycle, they started financing some of their clients to purchase more routers. It's happening with Nvidia already. They're starting to finance via joint ventures so they can afford to purchase more chips. It's an Nvidia-centric bubble, whatever you want to call it. We don't know how long it's gonna last. I mean, the plans are to spend $5.5 trillion on infrastructure. I came up with a new saying today: trillions don't grow on trees. But think about how much revenue this is going to have to produce to get even a 10% return on capital, which would be $550 billion in profit. There are clearly going to be some winners, but there are also going to be a lot of losers. And Meta, by the way, is smart enough to have structured that debt non-recourse to them. It's recourse to the projects, and they are not committed to build those. And if they don't, they're not on the hook for it. So that tells you one thing. And we tend to read covenants when we buy stuff. People in benchmarks, may or may not, depending on how much staff they have. But these bonds are, Oracle did a big deal in September. They had $18 billion worth of financing for data centers. Those bonds are already down 7 points. So we'll see where this all shakes out. But it has echoes of 2000. I don't think it's going to repeat, but it's certainly rhyme. And there will be winners. AI has some great uses. I think the tech layoffs that you're seeing as a result, they're using AI as an excuse, I think. I think a lot of those layoffs are just because they hired too many during COVID. Amazon, perfect case in point, hired a lot of white-collar employees. They don't need them. Not because of AI, I don't think. But, they just have to cut back, and the excuse is a good excuse. But I don't know if you've ever used an AI assistant for customer service. I always have to end up with a real person on the other end of the phone. And these companies figure this out, and as AI needs to continue to raise prices, they're going to say, I have to pay a ton for this application. I can hire people cheaper. So it's not going to be as demonic as some of the Cassandras make it out to be in terms of eliminating everybody's job.
How do you think about sector concentration when you think about your portfolio? That's something we ask equity people all the time, but I'm wondering how that's different in a bond portfolio, like how much you have to be concerned about your sector allocation.
We are aware of it, but if it's a good sector, we don't mind being overweight. So, for example, distributors, we own all of them that make sense. The only one that doesn't make sense right now is Cisco, which is investment grade, doesn't yield enough. So for us, if we like a sector, we don't choose. So an equity investor probably wouldn't own MasterCard and Visa. They'd pick one or the other because they don't want to be overweight the sector. We would buy both. They're both good companies. Because in bond land, all I'm worried about is getting paid back and getting my interest. One can be a slight winner over the other, and the stock can perform much better. But in terms of fixed income, they'll both pay you off, and they'll both mature and get refinanced, but they're both high quality. So that's a little bit different fixed income investing than equity investing for sector. We're clearly aware of our exposures. Industrial has always been a big sector for us. But industrial has such a wide swath. It's everything from car manufacturers to makers of widgets to whatever. It's a big sector, so they're not intertwined in the same dynamics, if you will.
I'm also curious how position sizing is different. That's another question we always ask equity investors in terms of how many positions you have, but also in terms of the percentage in each position. How do you think about that?
Well, for us, we have 120 companies in the portfolio. So you can just do simple math and figure out that, each one's going to be slightly less than 1%. Some of them are greater than 1%. Some of them are less than 1%. But we think in terms of about 1% as a full weighting for us. When we have a greater than 1% position, it's typically a higher quality company with what will have multiple bonds. And what puts them over the 1% is we'll have a big weighting in the shorter maturities. But unlike equities where you get an Nvidia or a Google or an Amazon, that you can start as a 1% position, all of a sudden it's a 5% position because it's grown so much. Doesn't happen in fixed income. Funds don't go up fivefold.
I want to shift back to private credit because we talked about at the beginning. I know you're not optimistic on it. It doesn't seem like you have any positions in private credit right now, but I'm just wondering, you're someone who sees what's going on behind the scenes. And we've had some guests with what happened with Tricolor and what happened with First Brands are saying there's cracks in the system and this could be a systemic problem. I'm just wondering, as someone who sees what's going on behind the scenes, what are you thinking about what's going on in private credit? And do you think there's any merit to that type of stuff?
I think that in those two cases, they were company specific. One was outright fraud and incompetence, and the other one was just, when you're hypothecating the same assets 4 or 5 times, that's just fraud. Now, should the underwriter have done a little more work and found what that lone researcher found and made public? Yeah, he should have. Could he have found that out easily? Probably not easily. Fraud is usually pretty well hidden. But those are the types of companies and managements that can finance in the private markets. And, what we found is that when you have hedge funds and these guys all talk to each other and they're all in the same trades, they all, they love the warmth of the herd. So you'll have a bunch of guys in the same names. I think that, what we've seen so far, and it's pretty opaque, but Fitch had a report that they saw year-to-date defaults in private credit were as high as 9.5%. You've got loans year-to-date default is in the low threes, and high-yield defaults are about 1.7, 1.8. So you can see the tiering of defaults there. I think defaults in private credit are going to rise, and some of that is just these companies are over-levered, and their end markets are tough, either through tariffs or whatever, and they're just not going to make it. So you're going to continue to see most of the defaults are going to be in the private credit area. I don't think it's systemic because every company has a different business model. And what it seemed to me was that those two companies, one was sort of parts and retail, and one was lending, subprime. They're both different businesses, even though they both are in the automotive area. I think automotive is an interesting one because, as prices go up and wages stagnate, people are spending more and more of their income dollars on their transportation. Cars and cable are the last two things people want to give up. They want to live in their car, give up their home. But that's a tough one. But I read somewhere the average car payment is $600 a month in the U.S. and the average age of a car is 14 years. Now, you guys know that when you go into a subprime situation and you're buying a used car, first question they ask you is, what monthly payment can you afford? So you're shopping based on your monthly payment, not the egregious interest rate that they're slapping on you to get to that payment. So there's going to be probably more defaults there going forward, but that's always been the case with subprime auto. You're always going to see a cycle there.
I just bought a car, and good luck getting them to tell you what the price of the car is.
I know.
It takes forever to get them to tell you what you're actually paying for the car because they've got all this monthly payment stuff they're throwing at you.
No, exactly. I just go through the fleet dealer and I say, this is I have the information. This is what I pay. Let me know when you can do it.
I'm just curious, since you're familiar with the space, do you have any thoughts on? It seems like there's a lot of efforts being made to bring private credit to the masses. I mean, there's an ETF now that has at least partial private credit behind the scenes. Do you have any thoughts on that? On this whole idea of trying to bring private credit to everyone?
It's revolting. I mean, private equity, private credit, alternatives. their returns have been mediocre at best, and the institutional buyers are selling. I mean, you saw some of the college endowments have been selling their private investments off at 10% discounts. So they're not buying their new funds. So they need new buyers. And what better buyer than the little guy? I think I don't like it. I don't think it's right. And I think that people should be very careful when you're looking at these things, especially in their retirement funds. That's just my personal opinion. I'm sure a private equity guy will give you a different answer.
So I was looking at the, and I don't know if this is completely up-to-date information, but I was looking at the positioning of your fund, and it seems like you have most of your portfolio in high yield now, and that kind of goes back to what you were talking about before. But it also seems like you have a pretty short duration on right now, and I'm just wondering what the reasoning behind that is.
Okay, what we typically do is, in a perfect world, when the market keeps climbing and climbing and climbing, we get more and more defensive. And the way you do that in fixed income, you can do it two ways. You can go up in quality, or you can go down in maturity, or duration, as they call it, the sensitivity to interest rates. And we tend to do it by building short-term positions. Last time we did this was sort of 18, 19. I don't know if you remember, rates were very low in high yield. I mean, I think the high yield market yielded 5%. That wasn't enough yield for us to justify, even though spreads were bigger than they are today, because the investment grade universe was trading at near 0.5%, 1% in the 10-year. So spreads were okay, but the absolute yield was not acceptable. So we built cash, let cash build cash. And by cash, I mean money market, treasuries, commercial paper, bonds maturing under a year. That's kind of the way we view our short-term bucket. So coming into 2020, we had 35% in defensive short-term assets. That worked really well during COVID. Everybody was selling, we were buying. We've never been down 10% in any time period, ever. We hope to continue that. Right now, I think we're going through another phase where, companies are issuing bonds with 5-handle coupons for 8, 10 years. Some are going to approach 4 again. So we're going through that again, where there's too much money chasing too few bonds. And for the better companies, they're very shrewd and they finance very cheaply. We tend to buy those when the market cracks. So right now, we have probably been too defensive too early, but we're up to about 40% in short-term defensive position. And some of that is investment grade, some of that is double Bs. But we are very well positioned and very liquid, because when the market does crack, we never know what's going to set the market off. Who knows what it's going to be. But when it does, it usually happens. It unravels pretty quickly. And we have our list of bonds that we would love to buy on weakness, and we'll be ready. People always ask after the fact, they say, well, aren't you finding liquidity really difficult? And so if you're a buyer and everybody's a seller, no, liquidity is really nice.
So we
are pretty defensive now, but we have about, 68% in non-investment grade, right?
And so is cash in there as an optionality? I haven't looked at the holdings, so I don't know. Or is it just rolling off, and as those bonds sort of mature, that you're kind of looking at those opportunities to deploy?
Typically, we do that a little differently than most. See, most funds, when they get cash in, they reinvest across their portfolio. So they'll go out with a program bid electronically or otherwise and say, I need to buy, $40 million worth of bonds spread between 300 issues. So we'll go out, get an offering on those and put it to work. So the portfolio looks the same from day to day. We don't do that. Goes to treasuries first, then we look at commercial paper, we look at short-term bonds, and we'll reinvest as we find opportunities, which only may take a day or 2 or 3 or 4, who knows. So that's how we do it, depending on how we're positioned. If that cash happens to show up in a period like March of 2020, we're going to be buying bonds at 70, 80 cents on the dollar that yield 9, 10%, as
What?
opposed to rolling it into short term.
Yeah.
So
Well, you
that's
have
what the
that,
opportunity set is at the time.
and you have the cash coming in that,
And we
from,
always have cash coming in. Right?
yeah. Yep. That's good. What is there anything else in terms of like risk management that you can think of? I mean, it seems like to me, the risk management is embedded in the due diligence and looking for those high quality companies, like you explained before, like a stock picker would.
Yep.
And that is sort of how, but is there, because, you're more concentrated than your, typical bond index fund, but you're, doing much more deep, fundamental research.
Mm-hmm.
And so is that the secret sauce of the risk management, in your opinion?
That is one of them. That's a very important one. The other one is duration management. I mean, quite frankly, when we set this up, we made sure that we had the flexibility to go to cash if we needed it, cash substitutes. And that's a really important part of it, because when the market sells off, everything sells off, including the short-term stuff. Short-term bonds trade off a lot less. So you can have a short-term bond yielding 4.5%. It trades off 1.5%, and it's yielding 6.5%. Whereas a longer dated bond yielding, say, 7%, if to get that up 2 percentage points, you probably trade it down 20 points. So that's the cushion that we like to build into our portfolio, because when it does happen, there will be weakness across the board. We're not immune to being down. I gotta tell you, most of our clients are RIAs and endowments and foundations, and some independent broker-dealer networks. I guarantee you they're getting more calls about the fund that's down 20, 25% than they are about our fund.
Right. Yeah. Yeah. It's those drawdowns that, get clients and investors worked up and worried, for sure. And if you can control that, then that's that, investors will stay with you for a lot longer.
As you know, the risk tolerance is very asymmetric. When things are going up, they're always asking, why are you lagging? Our clients actually aren't asking that. They know why. But, when it trades down, it's like, why were you in that? When it's going up, it feels good. Goes down, they
Right.
get barely sensitive.
Yeah. Yeah. Let's talk about the Fed for a second here. So I'm not going to ask you to predict where you think interest rates are going, but it's an interesting time for the Fed. So they sort of started this easing cycle. There's now, seems like there's maybe some doubt around a December rate decrease. You have, government data basically non-existent for the last 2 months, essentially. There does seem to be some weakness, seems like, in the labor market. You have, their inflation's running higher than their target, but okay, 3%. It's not off the chains or anything. But just what do you think? I mean, how do you you would think an easing cycle would be a start of an expansionary sort of time for the economy as more fuel comes on the fire, but it might be an interesting time where they're easing and then you have this weakness in the economy that the rates don't maybe affect in some way. I don't know. Just share your thoughts on sort of how you guys are thinking about this here.
The Fed's kind of caught in the box, right? So their two mandates are inflation and employment, right? Supposed to keep them both steady. Unfortunately, they have to favor one or another. They can't do both at the same time. So for 22, 23, 24, they were focused on inflation. Let's get inflation down. Let's slow down this economy, because, we had so much stimulus during COVID that had to work its way through the system without causing too much inflationary damage. Okay, so we've gotten through that. Now inflation has started normalizing. As you pointed out, it's not quite where they want it to be, the mythical 2%. And you've got an administration believes in tariffs, which are a tax and inflationary, but they also want lower interest rates because they're real estate people and like lower rates. But lower rates are by themselves inflationary. So if you lower rates, what happened, at the end of last year when they lowered rates in September, October, is the bond market said, oh my God, I do not need more stimulus now. That's going to be inflationary. So the 10, 20, and 30-year rates shot up to 5%. So a little bit of that has happened here. I mean, when they cut last time, the 10-year rallied to 395, but then immediately bounced back to, 415, 420. I mean, they had an auctions today, so see where those settle out. But I think, we used to have what we used to call bond vigilantes, which would keep, a tight hand on the Fed by not manipulating, but, expressing their views via the bond market, may come back. We've got large buyers of treasuries that are no longer there. China's no longer buying our treasuries, right? They've got their own problems. They have a huge deflationary problem that they have to deal with. So they're going to be spending money on stimulus, not buying our bonds. We are running huge deficits. So we're going to have to finance a lot. And while the White House would like to see lower interest rates to finance into that, we've stopped immigration, so population growth is much slower. You don't need to create as many jobs today as you did when population was growing. So the fact that the number of jobs being created is lower is not necessarily showing weakness in the economy. It's actually probably normal between 0 and 50,000 is what I'm hearing from people. And all the layoffs you've seen in tech, they don't add up to a big number, 10,000 here, 15,000 there, 20,000 here. Just like, if you have 100,000 in layoffs, it's a bad month, but it's not the end of the world. When you get to the millions, then we'll talk. But so the Fed has been focused on employment recently. And they don't know whether it's weak or strong because A, they had a shutdown, so they didn't have the people to do the surveys. So keep your eye on the revisions. They're going to be huge once they get the initial numbers out, and then they do the catch-up work and get the real numbers. Probably have some pretty big revisions. Most people don't pay attention to those, but I think we should this time. And if the Fed cuts again with M2 at an all-time high still, that's inflationary. So that they're playing against themselves.
This has been a really solid discussion because I think it, setting up how we did at the beginning, just your ability to explain this to our audience has been really, really good. And I think it's like a lot of like just common sense thoughts here. So we really appreciate that for sure. And I think what our audience should also understand is that, you're hearing from someone that has an outstanding long-term track record over, multiple market cycles. So there's tons of wisdom and knowledge in here that Carl, you shared with us today. And yeah, we have 2 standard closing questions we like to ask all of our guests, if we could have you just for a few more minutes. The first one is, what's the one thing you believe about investing that most of your peers would disagree with you on?
Well, I still think it's about providing a low volatility, reasonable return to investors, whereas I think some of my peers might think it's about, going for broke when, the time is ripe, and then letting the cards fall where they may when they're not. I mean, we don't believe in taking excess risk at any time, but you see a lot of these funds, you look at their positioning, we would not buy half of those names. But, that's what they do. They go for broke. That's one thing.
And the final question is, based on your experience in the markets, what's the one lesson you would teach your average investor?
Be patient. Don't fear missing out. Always get another chance. And I think, only invest what you can afford to lose in most cases, and be able to sleep at night with your investors. As a former partner here used to say, Carl needs his beauty sleep more than anybody. Just look at him.
Nice. Well,
And he's
Carl,
still here.
oh, nice. And you're still getting your beauty sleep, so something's working.
Trying.
All right. Thank you very much, Carl. We really appreciate it.
Thank you very much.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.